In this lesson, we will identify the top 3 denial reasons pertaining to bank statements and investor flex loans. As you know, future mortgage and investments bank statement and investor flex products have tough guidelines that can cause denials. The 3 most common denial reasons are debt to income or DTI, credit issues, and title and vesting issues. Let's start by highlighting how these issues affect bank statement loans being approved. Bank statement loans allow qualified self-employed borrowers to be approved by providing personal or business bank statements instead of income docs or tax transcripts. With a maximum DTI of 50%, this means that DTI is significantly more important. Within the issue of debt to income, we often see a problem where there are insufficient funds to close the loan. Primarily, this is caused by clients not having funds to cover reserves, or attempting to use funds that are ineligible. Remember that the borrower will need 6 to 12 months of reserves in their account, depending on the loan amount. Another underlying issue for DTI is excessive obligations in relation to income. In this situation, the client either included deposits that are ineligible in our calculation, or more commonly, there was a commingling of funds in the account they wanted to use. Commingling of funds happens when the personal account is used to pay business expenses or deposit business income. If funds are commingled, you must use business bank statement analysis method, which calculates income in a completely different way. Another issue borrowers often run into when getting approved for a bank statement loan is credit issues. In most cases, the borrower on these loans do not have enough active trade lines to meet the product requirement. Both bank statement and investor flex loans require a minimum of 3 trade lines from traditional credit sources that are reported for 24 months or more, and at least one of these trade lines must be open and active for the last 12 months. Please note that authorized user accounts will not be considered as a credit reference for establishing this minimum required history, and alternative credit histories will not be permitted. So that is the most common denial reason for bank statement loans. Now, it's time we discuss the denial reasons for investor flex loans. Investor flex loans are for investment properties only and allow borrowers to use the market rent of their investment property to qualify for a loan, rather than using their current income. Just like bank statement loans, we often see a problem where there are insufficient funds to close the loan. This is typically caused by the borrower not having enough for the reserves. For investor flex loans, the borrower is responsible for having 12 months of reserves, and only 50% of that can come from retirement accounts. Another denial reason that investor flex has in common with bank statement loans is excessive obligations in relation to income. However, for investor flex loans, this type of denial has to do with the expense ratio for the subject property being too high. Normally caused by the 1007 coming in low or not including an expense like HOA dues, taxes, or insurance. Another issue borrowers often run into when getting approved for an investor flex loan is credit issues. As mentioned earlier, both products run into issues with the borrower not meeting the minimum trade line requirements. It is also worth knowing that the minimum FICO score for both products is 640. However, for investor flex loans, the minimum FICO score will be 720 if the borrower is a first-time investor. The final denial reason that we see often among both products is that residence vesting cannot be verified. This can be caused by a mix of title vesting issues and issues with the borrowers meeting the residence history requirements for the product. Great job! Today we identified the top 3 denial reasons pertaining to bank statement and investor flex loans. If you have any questions, please reach out to us. Thank you for watching.